In this series of lectures, I'm going to teach you how to value financial assets, and these financial assets are going to typically be corporations. They might be divisions of a company. They might be not-for-profit companies, but in any case, they are some sort of financial corporate asset. And the real question, the basic question here, is how much is such an asset worth to a particular buyer? Now, this is not a very interesting question if the asset happens to be publicly traded in an active market, because then you have a really good idea of how much it's worth, at least to some buyers, because they are actively trading it. So, for example, common stock, IBM stock, or General Motors stock, see how much that is trading for on a day-to-day basis. That gives you a good idea of how much at least the market considers it to be worth. And if you apply these techniques to companies like that for the purposes of evaluating their common stock, well, simply you're just determining how much you think the asset is worth relative to the market price, and really not all that useful an exercise. Rather, what's a whole lot more useful is figuring out how much a private company ought to be worth, a division of a public company ought to be worth if you're considering, for example, purchasing that, how much not-for-profits are worth, for example, community hospitals, and what you again want to know is how much would you be willing to pay for such an asset. Now, there are two basic methods for doing valuation. One of them, the gold standard method, is simply for you to estimate future cash flows, which when I say simply, that's not all that simple, but you estimate future cash flows, find their present value at an appropriate discount rate, and that will give you either the stock value or the enterprise value, perhaps if you do some subtraction of non-operating assets and debt. But in any case, you can calculate that from expected estimated future cash flows. Many times, however, you don't have enough information to do that, in which case you've got to rely on second or third best methods, which are basically using comparable companies and multiples analysis. And that would consist of finding companies that look like the company you're analyzing, and then for those similar companies, calculating price to earnings ratios, enterprise value to sales ratios, other types of ratios as well. Now, the disadvantage of that is that frequently it's difficult to find comparable companies. And it's also frequently difficult, once you have comparable companies or even your target company, to find actual financial data, because if you don't have enough financial data to estimate future cash flows, you may not even have enough financial data to calculate these ratios. Nonetheless, number one, the gold standard. Number two, what you do if you don't have enough information to apply future cash flows. And we will start off with number two, which is estimating values of companies using multiples analysis.